Hey everyone. The laziest and most intelligent way, I think, to build wealth relies on borrowing something that goes down in value to acquire something that goes up in value. Property investment has been and will likely continue to be one of the most common and effective strategies to build wealth. Simple. Lower interest rates have supercharged property and equity markets worldwide, especially since the 1980s. And while there's been some ups and downs during this time, interest rates have overall trended downwards, with lower highs and lower lows with each economic cycle. Now, to respond to the events in the last 18 months, central banks around the world have doubled down even further on their tactics of artificially suppressing interest rates and encouraging the supply of new currency where appropriate. It's easy to be critical of this approach, though, especially in light of the rising distance between those who own assets and those who don't. But the path of least regrets appears to have been successful in maintaining our confidence in the financial system. So in this video, I'm going to cover off some recent changes to bank lending rules and how it affects everyday homeowners in New Zealand. Then I'll cover off a real-life case study. And finally, I'll take you through a perspective on how this could actually impact the New Zealand economy at large. Now, if you're new to the NZ Everyday Investor on YouTube, please subscribe and like this video to hear more. I cover a lot of mainstream investing material like investing in managed funds, property, shares, and cryptocurrency, but I also insert some unique perspectives that aren't normally seen in mainstream sources. All right, so those with the gold make the rules. You've probably heard that before. But these rules are changing. So who are these rule changes going to affect the most? Well, think about the following groups of people. If you've bought a property new off the plans, many loan approvals given only last for a few months, and once they expire, the latest rules will apply. If you've been planning significant renovations and you haven't obtained full approval from your bank yet to proceed, you also could be at risk from changing goalposts. Even worse, if you've started a project already, you may need to get an updated approval if your project takes even longer to complete. What if you're an upgrader, or you're thinking of selling and buying something bigger? Well, just because you obtained an approval from the bank for more than enough last time, there's now a risk that it could be far less than enough this time around. Now, many households in New Zealand have found their mortgage payments shrinking pleasantly over the last 5 years especially. It's never been as cheap as it is now to be a borrower. However, it's never been this hard to become a borrower. Let me quickly explain at a simple level what happens when you seek funding from a bank. Simplistically, the banks look at what you own less what you owe, what you earn less what you spend. If you have a little bit left over after they stress test your numbers using a higher than expected interest rate, they'll be happy to lend and off you go. Now, it isn't quite as simple as this, of course. For instance, banks in New Zealand are registered by the Reserve Bank of New Zealand to operate, and they need to meet certain guidelines in order to achieve and to retain their banking license. In addition to that, they have to follow all relevant bits of legislation that apply. So not only are you dealing with those with the gold who make the rules, but you're also dealing with those higher up who determine who gets to lend out the gold in the first place. Now, on the 1st of October, changes to the Credit Contracts and Consumer Finance Act, the CCCFA, put really simply, means the following. The banks will capture far more information on all of your expenses. Now, the banks will require a far more specific disclosure on everything that you spend money on. Inevitably, I suspect many borrowers will be disclosing higher, not lower expenses, and this ultimately will reduce borrowing power. If you anticipate a reduction of income in the future, the bank wants now to know how you're going to cope, sometimes with evidence to show that you can keep the mortgage payments going. What about if you're thinking of having another child, or changing jobs, or making a move into the self-employment contractor space? Well, change is going to affect you as well. Now, for some borrowers, there now needs to be some sort of exit strategy where it's unclear that they could repay the mortgage in time for retirement. Now, let's have a quick think about this. What happens if you do have a child, as an example? Perhaps you drop down to one income. Then, at the same time, you feel a need to sell and get a larger home. Kind of makes sense. In your world, this may come with reduced income or increased expenses in the form of childcare. With less income or higher expenses or a combination of both, you have less borrowing power now. Well, our banks always have had our back in the past. They'll take care of us again in the future. I'm not so sure about that. To be blunt, having a sympathetic bank manager is great, but they're not going to break the law to help you out here. If you're thinking of making a move now that may rely on more bank lending in the future, you now need to be far more strategic with your next steps. So by permission, I'm going to share an example here of some actual clients that I'm working with now. This couple lives in their own home and they own a rental property. They both work, they have a child, they have a retirement goal, and they invest in managed funds for a portion of their strategy. They're using all the right tools. Prior to the banking rule changes, they were able to borrow $1.4 million. This is what they did actually do when they purchased their most recent property. In the next 12 months, though, they have some concerns about some events that could reduce their incomes. What they wanted to know was this: if we decided to sell our home and purchase something at a lower value now to reduce our expenses, what are the options? Although they qualified for a $1.4 million loan last time, they now only qualify for a $1,050,000 loan under the latest rules. This is a whopping $350,000 less, or a 25% reduction in lending now possible. Now, even if they wanted to improve their affordability by reducing their mortgage, they're now not incentivized to do so. Okay, so far I've briefly covered what the rule changes involve, who may be at risk, and an actual case study. Here's what I think about the latest rules. I think higher interest rates could have been a better move. However, as I've covered on the video on the screen now, any and every excuse to keep interest rates lower for longer will likely be relied on going forward. Loan-to-valuation ratio restrictions, increased taxation for property investors, in fact, higher taxes in general. We've seen all of this during a period of time in which the property market has increased by around 25%. These are some pretty significant changes we've been exposed to in a pretty short period of time. But I suggest that these changes could reduce the amount of new money being injected into the economy, and this could have a far deeper impact. Now, to understand the mechanics of how this could play out, you need to understand a little bit more about the role of banks in the economy. Most of us are taught that banks are the middleman. They transfer funds from savers to borrowers, and they clip the ticket in between. This is one of 3 theories on banking called the Intermediation Theory. There are some links in the notes where you can learn a lot more about this if you like. What I want to briefly explain, though, is an alternative theory on banking called the money creation theory. This theory suggests that around 97% of money is created on the spot by retail banks when they serve up loans, operating under a license from a central bank. Most of what I've read around this theory comes from overseas, and to date, I've never been able to confirm if this is actually how it works in New Zealand, but if it's true, then the supply of new money comes from the banks, comes from the retail banks. If we assume that economic growth occurs when the volume and the speed of currency moves around in the system, this means that indirectly the retail banks play a massive role in amplifying the boom-bust cycle of our economy. Now just think for a moment about all the consumer spending, which is effectively a function of bank lending criteria. Every time you borrow for a new car, take a holiday, buy an investment property, or take out a loan for your business, new money is potentially created that didn't exist before. So as per my couple in this example who had 25% less borrowing power going forward, if that's true for enough New Zealanders out there, there's now far less new money sloshing around creating growth, and ultimately less tax revenue also. This is huge, and yes, it could affect house prices, but it could also be recessionary. Let's go a little bit deeper still. Those with the gold make the rules, but who says they have the right to hold the gold in the first place? Well, the central banks do, just like the Reserve Bank of New Zealand. Now, what I learned at school and university was that interest rates, which can be changed by a central bank, can control economic activity. This is the reason why, when things are running hot, you can expect interest rates to rise, but when things are running cool, you'd expect interest rates to fall. Richard Werner, a professor of banking and finance at De Montfort University, conducted some research on the relationship between interest rates and economic activity, link in the notes. He found that, in fact, there was no evidence whatsoever that lower interest rates create economic growth. In his words, the empirical evidence rejects what has been declared repeatedly by economists and central banks as their core monetary mantra, that lower rates lead to higher economic growth. They do not. Reality is the opposite in 2 dimensions, correlation and causation. Higher growth causes higher interest rates. Full stop. This actually really bothers me, if I'm honest, because it's the opposite of what I believe. If it's true, though, that higher growth causes higher interest rates and not the other way around, this means that the growth that we've seen, especially in the last 18 months, is nothing but vaporware. The only logical reason for the growth that we've seen in property and share markets over the last 18 months is perhaps only a distortion caused by inflation, and inflation specifically caused by way too much new money creation. So in other words, lower interest rates cause lower growth. And this is the crux of the matter. Because we believe the response from the central banks have rescued us from a greater evil, our economy can basically run on any fuel we like, including theories that aren't true. In essence, and put very simplistically, new currency gets created when you take out a mortgage from the bank, sloshes around a bit in the economy, and then it gradually dissipates through taxation. What the Reserve Bank createth, the taxman taketh away. Anything and everything, therefore, that seeks to limit the supply of new money being created could have the potential to strangle the goose who's laying the golden eggs. Now, I know this line of thinking can be a bit controversial, as it sounds as though I'm making a big deal out of something that only affects a small portion of New Zealanders. Time will tell if any of my concerns noted in this video were actually valid. But if you're in a situation where you feel these changes may directly impact you in some way, the best thing for you to do is to reach out to your bank or financial advisor sooner rather than later. Try to understand what risks you may be exposed to and how, if possible, they can be avoided altogether. Cool, that's it for this video though, and I hope that you enjoyed that. Please be sure to subscribe to the channel and give this one a like if you got something out of it. Now, while I cannot provide financial advice on YouTube, please leave a comment if there's another area around this topic that you'd like to hear more about. Cool, catch you next time around.